Somewhere in America, two people are applying for similar mortgages. They earn similar incomes. They've both spent years saving. Neither has ever declared bankruptcy. On paper, they don't look very different. Yet one application moves forward, while the other quietly stalls. Not because one person is more honest, and not because one works harder. In the eyes of an automated system, one of them simply appears statistically riskier. Even a single point can shift how an application moves through that system. That decision often begins with 3 digits, a credit score. Every day, lenders use credit scores as one input in millions of lending decisions. Most people know roughly what their score is. Almost nobody knows where it came from, or why one private company's mathematical model quietly became part of America's financial infrastructure. Most assume this system has always existed. It hasn't. Many assume the government built it. It didn't. The modern credit scoring system grew out of a question asked nearly 70 years ago. Could financial risk be measured more consistently with mathematics than with human judgment? That idea slowly reshaped American lending. But the score itself wasn't the biggest invention. The system built around it was. Lenders adopted it. Mortgage markets were built around it. Software integrated it. Investors learned to rely on it. Eventually, an entire financial system began speaking the same language. Today, that language is beginning to change. To understand why, we have to go back to a time before anyone had a credit score at all. Walk into an American bank in the 1950s. There's no online application, no instant approval, no 3-digit number waiting on a screen. Instead, you sit across from a loan officer. They ask where you work, how long you've lived in town, and what property you own. Sometimes, who knows you? Every lender had its own way of deciding who deserved a loan. Much of it came down to human judgment. Sometimes that worked. A banker who knew your family might approve a loan no formula ever would. But judgment wasn't always consistent, and it wasn't always fair. For decades, lending decisions could be shaped by factors that had nothing to do with a person's ability to repay. Race, sex, marital status. Congress eventually responded with laws like the Equal Credit Opportunity Act, making many forms of credit discrimination illegal. But the underlying problem remained. The financial industry needed a more consistent way to evaluate risk. In 1956, an engineer named Bill Fair and a mathematician named Earl Isaac founded a company called Fair, Isaac and Company. Their goal wasn't to replace bankers. It was to help businesses make more consistent decisions using statistics. Instead of asking, "Does this person look trustworthy?" they asked, "What does the data actually tell us about financial risk?" At first, they built scoring systems for individual companies, one client at a time. Nothing about it suggested they were building something that would eventually touch mortgages, credit cards, and auto loans. Over the next 3 decades, their idea kept evolving. Then, in 1989, everything changed. For more than 30 years, Fair, Isaac and Company had remained largely invisible. They weren't a bank. They weren't lending anyone money. They were solving one specific problem. How do you evaluate millions of borrowers using the same standard? In 1989, Fair Isaac introduced the modern FICO score. It wasn't the first credit scoring model ever built. Banks had experimented with statistical scoring for years, but this one gave lenders something new. A broadly standardized way to evaluate credit risk using information already sitting inside National Credit Bureau files. lenders increasingly shared a common language for evaluating risk. 3 digits, usually somewhere between 300 and 850. Contrary to what many people believe, the score was never designed to measure character, intelligence, or success. It was built to estimate one narrow thing: how likely is this borrower to repay debt as agreed? That distinction matters because the consequences attached to the score grew far larger than the question it was designed to answer. The score became portable. You could move across the country, apply at a lender who had never met you. A standardized estimate of your credit risk would arrive before anyone even knew your name. Financial trust had become scalable. Here's where the story gets more interesting. Most people believe they have one credit score. They don't. They have many. Mortgage lenders often use different versions than auto lenders. Credit card issuers may use another entirely. Even Equifax, Experian, and TransUnion can produce different scores for the same person because they don't always hold identical information. There's a second misconception buried in here too. A credit report and a credit score are not the same thing. Your credit report is the record. Accounts, balances, payment history, credit inquiries. Your credit score is one model's interpretation of that record. Different scoring models can look at the exact same report and reach different conclusions. Research from the Consumer Financial Protection Bureau found that roughly 1 in 5 consumers could receive a meaningfully different score than the one a lender ultimately used. The number feels absolute. In reality, it depends entirely on which model is doing the judging. Useful tools solve problems. Infrastructure changes systems. That's what happened here. Credit scores helped lenders review applications more consistently. They gave mortgage investors a common language for evaluating loans. They gave software companies something standardized to build around. The score didn't replace lending decisions. It became one important input inside them. Over time, lenders, credit bureaus, mortgage investors, software providers, and regulators built their systems around the same scoring language. Once an industry that size learns to speak one language, changing that language becomes incredibly difficult. At that point, you're no longer replacing a product, you're rebuilding infrastructure. 2 institutions did more than almost any others to make that language permanent: Fannie Mae and Freddie Mac. Most Americans recognize the names. Few understand what they actually do. They don't usually lend money directly to home buyers. Instead, they purchase and guarantee qualifying mortgages from lenders. That helps those lenders recover their money, make more loans, and keep credit flowing through the housing market. Their standards influence a huge share of the conventional mortgage market. For decades, mortgages delivered to Fannie Mae and Freddie Mac relied heavily on classic FICO under the enterprise's credit score requirements. Not because it was the only scoring model available, but because an entire financial ecosystem had gradually been built around it. Lenders understood it. Investors trusted it. Software had integrated it. Underwriters had trained on it. Changing the score no longer meant changing one product. It meant changing the language the entire system had learned to speak. One of the biggest misconceptions about credit scores is that they decide whether you get approved for a loan. They don't. A credit score is only one piece of the underwriting process. Lenders also weigh income, debt, assets, employment history, property value, and a range of other risk factors. But that doesn't mean the score isn't important. For years, certain automated mortgage systems used minimum qualifying credit score thresholds before an application could even continue through parts of the approval process. One of the best-known thresholds was 620. that didn't mean everyone below it was automatically denied. Different lenders, different loan programs, and different underwriting systems all set their own standards. But for many conventional mortgages, that number became an important gateway. It decided whether the rest of the application even got considered. For decades, classic FICO remained deeply embedded throughout the mortgage industry. Then, lawmakers began asking a different question. Should one scoring model really hold this much power inside America's housing finance system? In 2018, Congress directed the Federal Housing Finance Agency, the regulator overseeing Fannie Mae and Freddie Mac, to create a process for evaluating alternative credit scoring models. Not to eliminate FICO, to introduce competition. In 2022, the FHFA approved two newer models for future implementation, FICO 10T and VantageScore 4.0. Both can analyze trended credit data. Instead of looking only at a single snapshot of your finances, they can examine how your balances and payment behavior have actually changed over time. Imagine two borrowers who owe the same amount on their credit cards today. One has spent years paying that debt down. The other has spent years adding more to it. A snapshot might make them look identical. A trended model might not. But approving new scoring models was only the first step. Replacing financial infrastructure takes years. Every lender, every credit bureau, every mortgage investor, every underwriting platform, every software provider has to transition together. It's closer to replacing part of a building's foundation while the building is still standing, occupied, and doing business. There's another part of this story most borrowers never see. FICO doesn't issue mortgages, lend money, or collect a single monthly payment. Its business is developing and licensing the scoring models used throughout the financial system. In fiscal year 2025, FICO's scores business generated approximately $1.1 billion in revenue, with an operating margin of roughly 88%. That's an extraordinary business. Not because FICO makes lending decisions, but because its models became trusted across an enormous financial network. Its greatest asset was never just the math, it was decades of adoption. Once an entire network builds around the same standard, that standard becomes incredibly valuable. Not because it's impossible to replace, because replacing it requires everyone to move at once. Today, classic FICO remains widely used. It hasn't disappeared. But for the first time in decades, approved lenders are beginning a multi-year transition that will allow alternative scoring models into parts of the mortgage market. Whether those changes improve access to credit, better predict lending risk, or simply replace one complex model with another, remains to be seen. This story was never really about a credit score. It was about systems, how a problem appears, how someone builds a solution, how institutions adopt it. Over time, that solution quietly becomes infrastructure. Most people forget was ever built at all. Your credit score isn't destiny. It isn't a measure of your character. It's a statistical estimate of credit risk, nothing more. But over the course of nearly 70 years, an entire financial system was constructed around that estimate. That's the hidden story here. Not how one company created a number, but how one mathematical language quietly became part of the machinery behind American lending. If one invisible system could shape millions of financial decisions without most people ever noticing, what invisible system is being built right now? One we'll all be living inside tomorrow, without ever having asked who designed it. This is The Ninth Hour.